Okay. In this session and in the coming few chapters, our focus is primarily on how portfolio can actually reduce the risk. So, portfolio as a word, we are saying it's mixing of two or more securities with an intention to reduce the risk. Portfolio can never give us a profit, but it can reduce our losses. The behavior of the two securities, if I choose in such a way that even if I lose on one, I gain on the other, that combination can effectively reduce my total risk. And overall, as we move today, what we will see is okay, a combination of a risky portfolio plus some risk free kind of assets will give a kind of an equation. What is the kind of return that I should expect from this combination if at all my risk is going to be this much? So that's the entire thing. The next, this and the next chapter are going to typically focus on. So in this chapter, we are trying to primarily look at how portfolio can reduce the risk. So for that, I wanted to demonstrate that entire thing through the Excel data itself. So for that, I have taken two securities. Let's say an investor is interested to invest fully in Infosys, or he may be interested to invest fully in Reliance. So whatever the money he has, he wanted to buy full shares of this or full shares of this. Or there might be someone else who might think that a combination of these two. Let's assume that these are the only two securities that are available in the market. So some guy wants to go fully for Infosys, fully for Reliance versus some combination of Infosys and Reliance, probably 30, 70, 40, 60, whatever it is, with an intention to reduce the risk. Now, how do I measure the risk? As we said, the risk is measured through standard deviation. One of the measures of risk is always your standard deviation. Of course, VAR and all are other concepts which we had to measure the risk, but a very basic mechanism of measuring the risk happens to be our standard deviation. Now, my intention always in a portfolio creation, the portfolio need not be with two stocks. I can have one share and one derivative, right? So if I lose on the share, if the derivative can gain, obviously my risk is getting mitigated, or vice versa. So that's where the portfolios generally will be like, okay, if you are already having a stock, right, you try to sell it in the future market, right? You already own a stock, you try to sell a futures contract, so that even if the stock price goes up, the future price will go up, and overall probably even if you are losing, the loss is slightly marginal, because you are still gaining something which is compensating some part of your loss. So it need not be built between two equity securities only. Any combination where my risk can be reduced. If my risk cannot be reduced, there is no question of portfolio at all, right? So that is what we'll see through our live example. So where I have taken, let's say, Infosys and Reliance, I want to find out first of all the risk associated with each of these two. So that's where I'll try to compute Infosys returns. What is the daily return which typically Infosys is has given over the last 1 year? So the return typically I am taking as the day 1 price minus day 0 price divided by the day 0 price, which is nothing but your percentage change. Percentage change in price is what is your return. So probably if I had bought Infosys on this day and sold on this day, I would have got this much of a return, either positive or negative. But this is for one single day. Like this, if I do it for almost all the days, this is what is the return I am going to get on Infosys. Similarly, I am going to do it on Reliance returns, where a same approach I am following. The Reliance day 1 price minus the day 0 price divided by the day 0 price. So this has been the return of Reliance. And okay, Nifty part I'll again come, or let me take it for the Nifty also, which will not use it now. but I'll use it for our CAPM, which we'll deal after this chapter. So yeah, this is my Nifty return. So the Nifty also changed by, let's say, 1%, 1.07%. It has gone up on that day. So that's where I can, that's what I can interpret. Okay, these are the three returns. Now I would like to find out what is the kind of variability that is there in these returns. That is what is the risk. If the return is consistent every day it is giving me almost the same return, then I will say that there is no variability in the return. So there is a consistency, no risk. Because the return is varying, you see a lot of negatives, some positives, there's a lot of variance in the return. So that variance I am trying to measure through the either variance or standard deviation kind of a tool. So if I simply try to find out the average return of probably the average, or let me call Infosys, Reliance and Nifty, for these three I'll compute, let's say, average, the variance and the standard deviation. So the average of Infosys returns is coming out, this is a daily return. So if I take the average return, so the average daily return which Infosys has given in the last 1 year is negative 0.03%, right? Minus 0.03% was the average daily return. But now if I want an annual return out of it, so probably I can multiply it with number of days. The number of days I have considered here is around 250. Right, so I'll multiply this with 250 because the trading days approximately will be 250 in a year, because Saturdays and Sundays are not there for market and all. So okay, 250 days. So this was what was the return Infosys has given in the last 1 year. There was a negative 8% return, 8.5% return in the last 1 year. Let me just make these as percentages so that we can look much better. Alright, so this is given a negative 8% return, but probably if you see for Reliance, the number may be completely different. So this number multiplied by 250, so it has given a negative 9% return, whereas Nifty during the period has given only a negative 1% return, which is clearly saying that these two companies have lost more in the last 1 year compared to the overall index. Nifty is again an index of 50 securities on the NSE. So Nifty has lost only 1%, whereas these two have lost this much. So which is clearly telling that all securities don't move the same way in the market every day. See, even if the market has lost, let's say by 5%, on a one single day, a big collapse, you will still see some securities would have gone up in price. Right? Yesterday also, where the market has gone up by 1.5% almost, we have seen that there are few securities which have gone down in price. When on a Nifty yesterday, when there were 50 securities, 48 of them have gone up, 2 of them have gone down. And again, Wipro and Asian Paints are the two companies which have gone down. So there is no relation to the sector also there. Right? Other things in the same sector have gone up. Infosys or all others who are in the IT segment, they have gone up in their price. Only these two have gone down. So we cannot, so depending on the investors' psychology and various stuff, we can typically see on some days, even if the market is down, some securities go up. Even if the market is up, some securities go down. So choosing the securities in such a way which have opposite behaviors, generally, in general terms, which have opposite behavior, is what will drive the entire risk management process. When I know that A and B always or to a large extent behave oppositely. If A goes up, B goes down. Or if B goes up, A goes down. If I can choose these two, then that is what is creating a good portfolio for me. That is where we say derivatives are playing a very important role in terms of creating a portfolio, because probably if the stock price goes up, the derivative price goes down, derivative value goes down, depending on the way we work it out, or vice versa, where your possibility of loss can be directly shorted. Okay, now if I try to find out what is the kind of standard deviation risk associated with the returns of these two companies, the standard deviation I am trying to find out on the Infosys return. This is also a daily standard deviation. I multiply it with square root of 250 to get the annual standard deviation, because variance is what I multiply with 250. So standard deviation is the square root of variance. So I have to multiply this with square root of 250. So it says around 30% variance was there, or standard deviation was there as a part of the Infosys returns. Whereas in case of Reliance, we are seeing that the risk is around 31%, a little bit more. Standard deviation is a very good measure of risk. So the Reliance is slightly more risky compared to Infosys as per our numbers, and probably the Nifty is much lesser risky. Right, Nifty is much less risky. Only 20% is the risk associated with Nifty return. So, sorry, standard deviation of the population, not for the sample. So variance is again a square of the standard deviation. So probably even if you compute it or do not compute it, hardly matters. So just for usage purpose, let's compute the variance also. But yeah, standard deviation itself is a measure of risk for us. Variance is just the squaring of the standard deviation, so it can just be one number for us. So this is what is the variance. Okay, now my intention is, if I invest everything in Infosys, there is a risk of 30.55% for me. Whereas, which means on a day or in a year, there is on an average, I may lose. The variance in the return is around 30.55%. In 1 year, on an average, the deviation from the expectation, my expectation is around this 8% negative. The deviation from the expectation, either on the positive side or on the negative side, on an average is around 30.55%. That is what a standard deviation is saying. So probably it may go to minus 38, right? Minus 8 is the expected. So on an average, there is a 30% deviation on either of the sides. So it can even go to minus 38, minus 8, minus 30, or minus 8 plus 30, probably plus 22. I may even gain up to 22%, or I may lose up to 38%, or sometimes even more than that also. So that's the kind of fluctuation that is there in the Infosys price. Same way with Reliance, I may go even up to minus 40 plus minus 9 minus 31, or minus 9 plus 31 up to plus 22. So that is the way. But whereas in case of Nifty, at least the range is much lesser. So because it's only 20% fluctuation, the range is slightly lesser. Now my intention of a portfolio always is there any possibility that if I combine these two things, in some proportion, the number goes below this. See, individually, if I am investing in Infosys, my risk equivalent is 30.55%, Reliance 31.74%. But can I do something where it can come down to 25, 26 with this combination? Which means risk still exists, but at least to whatever extent possible, I am trying to reduce the risk. That is where the portfolio management is helping us out. With respect to portfolio management, we have a few formulas coming up which simply say if there are two securities A and B, and A is giving a return of R1 and B is giving a return of R2, I invest, let's say, W1 portion in R1 and W2 portion of my amount in R2, where W1 plus W2 is equal to 1, the total investment. Out of the total investment, some portion in A and some portion in B. Then the return of the portfolio, this is what is a portfolio because I am investing in more than one security. My return of the portfolio simply comes out as W1R1 plus W2R2, which is the weighted average of the existing returns. And let's say if these two have independently, this has the standard deviations. Sigma 1 and sigma 2 are their independent standard deviations, just like the way we have seen now. 30% and 31% are the individual standard deviations of these two. Now, the standard deviation of the portfolio becomes the standard deviation of the W1 percentage in A and W2 percentage in B. So, which actually comes out as W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus 2W1 W2, the covariance between A and B. And this entire thing, this is a variance. So a square root of this entire thing comes out as the standard deviation of the portfolio. What it is also saying is, apart from the individual standard weighted average of their individual standard deviation, there is a lot of dependency on the covariance, on how both of them are behaving together. If one is up, the other is down. So that is what is contributed through a term called covariance. So as a term, variance is saying how much the security is deviating from the expected. That is what a variance or standard deviation are saying. But covariance is saying how much is the deviation of this security with respect to some other security. If some other security has changed by this much percent, how much this change? So it's relative to the other. It's not in isolation. Isolation is more like variance. But if I see the change with respect to the other, see, typically speaking also, just to give a brief idea in quant, anyhow we'll cover that again. So let's say x is having 1, 2, 3, y is having 3, 2, 1. So the average of x is 2, the average of y also is 2. And when it comes to variance, each number subtracted from its average squared. So 1 minus 2 whole squared plus 2 minus 2 whole squared plus 3 minus 2 whole squared, total is 2, divided by the total, so which is the average of the square of the deviations from the mean. So let's say the variance here is coming out as 2 by 3 and the standard deviation comes out as square root of 2 by 3. Even the same is the case with this. So individually these two are having some kind of standard deviation. Whereas what the covariance says is, okay, each one Instead of 1 minus 2 whole squared plus 2 minus 3 whole squared, what I'll do is, okay, 1 minus 2 into 3 minus 2. When x is 1, y was 3. So that's where x minus the x mean multiplied by y minus the y mean. So which is saying I'm not looking at the deviation of that own security, but I am looking at it in combination with the other security. This is what actually comes out as covariance. This entire number divided by 3 is the covariance. So what this says is, okay, both of them individually they are fluctuating in some manner, but I want to see if this has gone up, did this go down, or this is also going up only. If both of them are going up together, then probably there is no point. If I gain, I will gain heavily. If I lose, I will lose heavily. So they don't form a portfolio at all. Only when they show some kind of opposite behavior, if not perfectly opposite, at least a little bit of opposite behavior, then probably at least in some days, when one is going up, the other will go down, or when one is going down, the other will go up, and try to minimize my loss to some extent. That is what a portfolio's objective is. That's where when I combine the two securities, the return wise it's still a weighted average of the returns, but the risk wise there is a lot of dependency on the covariance that is existing between the securities, right? So let's try to compute the same stuff, and covariance wise there is one more relationship. Covariance also comes out as correlation multiplied by the standard deviation of these two stuff. So it's nothing but correlation is nothing but standardization of covariance, because covariance does not have any kind of boundaries. It can be any high. So if you are looking at the multiplication and all, it can be any high positive value, it can be any high negative value. So the interpretation becomes slightly difficult. Only the sign can be interpreted. If the covariance is negative, probably the relation is both are moving in opposite direction. If the covariance is positive, both are moving in the same direction. But we don't know how strong is that relation. So that's where correlation is a better word for covariance, where that covariance is actually normalized by dividing by their individual standard deviations. So which will have a boundary. Correlation always lies between your -1 and +1. So that boundary will typically say if it is closer to -1, probably it is more and more negatively correlated. Closer to +1, more and more positively related. Right? So let's try to apply this funda to our data and see if at all any kind of a combination can actually reduce our risk. The intention of doing this entire exercise is to reduce that sigma from 30%. See, the minimum of those two is 30%, 30.55. Can I find some combination where that can be reduced? That is what is my sole intention of doing this entire portfolio exercise. Weightage of investment. So let's say I have 100% of my money. 40% I invest in A and 60% in B. Then my overall return is the weighted average of that stuff. So here what I will take is, I will take some combinations. So I'll take Infosys and Reliance investment. I'll take some combination. Let's say 0% I invest in Infosys. Then obviously 100% I would be investing in Reliance, because I think there are only two securities for me. Right? So I'll put all different possibilities here. I do something like this. Then even in Reliance, my position is something like this. Now, going with that funda, I'll have to find out what is my portfolio return and portfolio variance, the portfolio standard deviation, going with our formulas. So return of portfolio and standard deviation of portfolio. So if at all any combination of this is going to reduce my portfolio standard deviation, I will prefer that combination rather than investing heavily 100% of my money in Infosys or in Reliance. See, anyhow this combination is saying invest 100% in Reliance. This combination is saying invest 100% in Infosys. Whereas these are some kind of intermediate combinations. But my end intention is not, as a portfolio manager, my intention is not this. My intention is more at this layer, reduce the standard deviation. Of course, we'll talk about the return also slightly, but my intention at the end is to reduce the standard deviation to a whatever extent possible. Right? That is what is risk management. Or as a risk manager, my intention is to find out an ideal combination which can reduce the risk to whatever extent possible. Right? So that is where the first step I am making here is finding out the return of the portfolio, where, okay, as per our formula W1 R1 plus W2 R2. So W1 times R1 plus W2 times R2. Okay, return wise, obviously it will lie between the two values only, because it's a weighted average. Weighted average always lies between the maximum and the minimum values. It cannot go beyond the maximum or below the minimum. So that's where you are seeing that it is lying between minus 9.31 and minus 8.57 only for different combination. Whereas once it comes to the standard deviation, what we are observing is we'll take the square root of that entire stuff, W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus that entire thing. So W1 squared sigma 1 squared is nothing but the variance. Sigma 1 squared. Yeah, sigma squared is variance. So that's where I'm directly pulling out the variance. So W1 squared, I'm not squaring it anymore. Right? Square is already taken as a variance. So W1 squared sigma 1 squared. W2 squared sigma 2 squared plus 2 into W1 into W2 into covariance. Okay, so covariance is still which we did not find out, or probably I'll directly find it out here. Covariance between the Infosys returns and the Reliance return. This is the Infosys returns, comma, the Reliance returns. So this is what we are trying to find out. And we are saying, okay, this is the covariance again is a daily covariance. But rest all I have taken it as annual. So probably even this one I will multiply with 250, because variance level I will multiply it with 250. So this happens to be my, so this is same as this number. Right, 100% of the investment in Reliance should be the same as this one itself. The standard deviation of full Reliance, even here also it is showing the same stuff. Probably for our understanding purpose, I'll simply put covariance as another term here, where I am saying the covariance between Infosys returns and Reliance returns. This is daily covariance. Multiply it with 250 to get your annual covariance. Probably here, instead of using this entire thing, I'll just use this value which we have found out. So this is the standard deviation of the portfolio. Now, when I take it down, this happens to be the standard deviation of the portfolio for different combination. But what you observe here is You see these numbers. You see these numbers where the the standard deviation of the portfolio has gone much lesser than the individual. See, if I put individually 100% in Infosys, my standard deviation was 30.55. With Reliance 31 point, but combination is only around 25. Some combinations are around 25 itself, which means the risk has gone down. Which means from a risk standpoint, putting fully in Infosys or putting fully in Reliance is more riskier compared to choosing this combination of probably 50-50 in Infosys and Reliance or 60-40. If I go with the least possible, then probably 50-50 in Infosys and Reliance is a much better combination than choosing anything else. Right? So, depending on my risk tolerating level, I have to choose a combination. Now, try to compare these two. Fully in Reliance versus 50-50. The risk is lesser, return is slightly higher than Reliance. Obviously, full Reliance is struck off. See, obviously any investor will try to invest in some kind of securities where he gets more return for a lesser risk. And this both are positive for the combination. Risk is lesser than Reliance alone. Return is more than Reliance alone. Right? Return is more than Reliance alone. Right? So, or probably just for our understanding purpose, what I'll do is these numbers I'll make it positive instead of negative. I'll just make them as positive just for our understanding stuff. Okay, so even in this case, for 31% risk, the Reliance has given 9% return. For the 30% risk, let's say this has given this much of return. Now, combination wise also I am seeing 25.77% is the risk, and it has given a return of 8.94. Yeah, if now you can compare probably Infosys versus the combination. Infosys wise is more riskier than this combination, and Infosys has given lesser return than the combination. Even with respect to Reliance, if you see, there is a heavy reduction in the risk, 31.74% to 25.77%. Heavy reduction in the risk, but the return was compromised only a little bit. Right? So, in all these cases, it is clearly giving us that a combination is always much better in terms of our risk mitigation than going fully into one single security investment itself. So, that is the prime intention of risk management. Create some kind of portfolio in such a way that the standard deviation of that portfolio, here we are talking of only 2. Probably I can create 20 like this. Add Wipro to it, add DLF to it. I keep adding, or add gold futures to it, add bond market to it. Anything I am adding, my intention in this entire process is to reduce the standard deviation component. Right? So, if at all I am able to bring it down to 0, in some form or the other, if I am able to bring it down to 0, that is what is a risk-free combination for me. Of course, in this, with these two, I am able to bring it only up to 25.77%. Could not bring it anything lesser than that. But if at all I tried and I can get it close to 0, whatever the return I am getting in that combination is actually a risk-free return for me. That is what actually the hedge fund companies typically targeted. The business of hedge fund companies anywhere is create combinations in such a way that the risk is as close to 0 as possible. That's where the name hedging. Hedging itself means reduce your risk to whatever extent possible. Make it as close to zero. And derivatives are really helping in creating those kind of combinations, because derivative is nothing but something that is derived from an existing, right? So probably you can use it in such a way, and that's true, there is a different trading market for it. So you can use that in such a way that it can very well reduce your risk to a large extent. That means you are almost hedging your risk, right? Okay, so at least if I am considering only these two, so don't limit yourself that these are two securities. Any two securities, the risk has come down to this much extent. Now the next thing that needs to be focused on this is, now if I try to plot a graph between the standard deviation of the portfolio and the return of the portfolio. So let me try to plot a simple graph which I call as a scatter plot. Between the standard deviation of a portfolio, so I call it as risk versus return graph. Risk versus return graph, where I am taking the standard deviation values on the x-axis and the return values on the y-axis. You see that this is the graph. This is the way the graph is coming. Now what is this showing us? That for a given level of risk, there are two possible returns. From the same two securities, the curvy nature is simply saying, let's say my risk is somewhere around here. I am ready to take some risk somewhere around here. My risk taking potential is this much percentage. I can have a combination here, or I can even have a combination here. Any investor who is having some basic common sense, for a level of risk, if he is prepared to take some amount of risk, he is always targeting the highest possible return. So which means a person who is willing to take this much of a risk will not choose this combination at all. He will go for this combination. Because graph wise, two combinations are possible. See, it's as good as just discuss here. Let's assume that the person is comfortable taking around 27% risk. 27% is his risk tolerance limit. When he is willing to take 27% risk, on one side he is having a combination which gives 8.72% return. Just compare these two things, this versus this. Between these two, obviously here the risk is lesser, return is more. So who will prefer this combination at all? No investor with at least a basic common sense will not prefer this combination. No investor will prefer this combination, and obviously he will always choose this instead of this. That's a very basic element in the entire thing. So what we are saying is, yeah, this is the typical graph which is saying all the possibilities between risk and return of a single portfolio, or of a single combination of securities. For different combination of the securities, what are going to be the risk return levels, right? This is the possibilities curve. all the risk return possibility curve. Now in this, what it says is, all these things, the ones which are downward sloping, if you look at this curve, there is some part where there is a downward sloping and there is some part which is upward sloping. What it says is, wherever there is downward sloping, this entire area from starting from here to the downward sloping part, this is typically called as, these are typically called as your inefficient portfolios, because no one will prefer them, because there are better alternatives for the same amount of risk. And this goes with a funda which says, which is a modern portfolio theory, which simply says any person will prefer, if he is prepared to take some amount of risk, obviously he will prefer the security or a combination of securities which will give the highest possible return. If I am ready to take this much of risk, for this risk, whatever is the best possible return I get, I'll go for it. I'll not settle down for the next. Or if my target of return is some amount, I'll always choose the one which is having the least possible risk to get this amount. So here also, when my intention is to go for, let's say, 27% risk, there are two combinations that are available. Obviously the lower combination I'll reject. So all these which are on the downward sloping curve are called inefficient portfolios, and the upward sloping are typically called as your efficient portfolios. And that's where this particular line, this particular upward sloping part of the curve, is actually called as the efficient frontier. Why we are talking of this efficient frontier? The efficient frontier is saying, for different risk levels, so there may be a person who is willing to take only 25% risk versus a person who is willing to take 30 or 31% risk. So different risk levels. So see, what we are saying is, not everyone will look at only 25%. Someone may say, I am ready to take slightly more risk also. Right? So for any person who is willing to take slightly more risk, still he can choose a portfolio on the efficient frontier. If I am willing to take 30% risk, I can choose a combination somewhere like 10 and 90. 10% in Infosys, 90% in Reliance. Though the minimum variance part is 25%, but I may be willing to take slightly more risk as an investor. I'm not okay. I'm okay even if I take 30% risk. I don't need 25%, but I need a better combination for that 30% risk. You cannot suggest me, because you are ready to take 30% risk, go and invest everything in Infosys. It's not a good combination. If I compare it with Infosys, 10% in Infosys and 90% in Wipro, in Reliance, is a much better combination for me. Right? So that is what is one thing which portfolio management is addressing. For a particular level of risk, I have to choose the one which is giving me the maximum possible return, which means it has to be on the efficient frontier. Otherwise, that combination will be a rejected combination. Right? So this is one. And probably with this combination of securities, this particular portfolio at the least risk is actually called as your global minimum variance portfolio. With this combination, this is the possible least risk that can be obtained with this. So you cannot bring down the risk. Thinking of Infosys and Reliance as a combination, you cannot bring down the risk below this 25% level. With a combination of 50-50 of these two, you can bring it down from that 30 and 31% levels. You can bring it to 25. Now, if your risk tolerance limit is only 15%, probably as an advisor, I should not suggest you even this combination, because as a combination, the risk associated with this combination is around 25%. If as a risk tolerance for you as an investor, is more than 25% or is much less than 25%, then even this cannot be suggested to you. Right? If you are at least up to 25% tolerance limit, 25 to 30, I can suggest some combination of Infosys versus Reliance for you. And that risk assessment typically happens based on various factors. Your age and dependence and various frameworks can be used, which can tell what is the typical risk taking potential of a person. So what kind of security? So probably only if your tolerance is between 25 to 30%, we'll suggest this kind of a combination. But what we are saying is, there are in this Infosys and Reliance combination itself, there are so many combinations which have to be rejected, which are in the downward slope. Only a few combinations which are solutions for different risk taking investors. So someone having a potential of 28%, I have a solution. 29%, I have a solution. Where you see they are on the upward sloping curve of your efficient frontier. Right? Now, what is the slope of this line? Right? This is a curve basically. Now, okay, I'll try to bring in one more extra concept into this, where we introduce a risk-free asset. Here, both the assets which I am looking at are risky assets. But I'll introduce a risk-free asset also to this combination, and then we'll see how the graph will get transformed. Right? When the risky assets only are there, what we are observing is the graph between risk and return is always a curve. So these are the various possibilities: global minimum variance location, and also I am seeing that there are a lot of inefficient portfolios and the efficient portfolios on the higher side.